So what to consider in times like this? I mean, the first message that you know, going back to that question that maybe a lot of you are thinking, look, why is the share market rallying now when this economic data is so poor? And the first thing we would point to is to say we think a lot of people overestimate the impact of a near-term event. So one of the things you can look at, one of the ways you can calculate the value of the share market or any individual stock is look at a discounted cash flow valuation. And so we've looked at a discounted cash flow valuation and just stress tested that valuation. So what we've done is we've said, what if COVID-19 eliminates 1 year of earnings? So the businesses on the ASX have no earnings this year, and then they really revert to the old earnings that they actually had. And what you find on a discounted cash flow is that that should have an effect of around 7.5% on the valuation. Then if you say, what if the companies have no earnings for 2 years and then just have normalized earnings and normalized growth, and we would expect then the market to fall by roughly 15%, and so on and so on. So at the peak of the kind of drawdown in the market to us was pricing in 5 years of zero earnings. At the moment, most strategists are actually only expecting earnings to drop between 30 and 40% in year one, and then slightly 10% in year two, and then back to normal. So we think that the market probably sold down more aggressively than it actually needed to do. And that's why, I guess leading back to Tony's point, it never pays to kind of panic, because a lot of people that were panicking were really panicking at the bottom. And so the other point that Tony talked to is that valuation matters. And when we look to do asset allocation for the portfolios, the valuation is one of the largest things we look at. And when you look at the valuation at the moment, this here shows the equity risk premium, which basically means what return do we expect on equities over bonds, or you may invest in cash or term deposit. And you can see with the equity, as the equities sold off, valuations got a lot cheaper. And to us, that was really a buying opportunity rather than a selling opportunity. So valuations are incredibly important, and the starting valuation that you actually invest in is very important. So to us, Australian equities are very cheap compared with cash, maybe not compared with themselves, but ultimately as an investor, we can only compare with other asset prices. And Australian equities at the moment look extremely cheap versus cash, bonds, and other kind of alternatives. Global equities, again, in the peak of the sell-off, they looked extremely cheap as well. The equity market has kind of had this rally. So equities are still sitting around having an equity risk premium of kind of 5%. So 5% per annum over kind of cash, term deposits, and kind of the 10-year bond yield. So to us, equities are still relatively attractive, whether that's Australian equities or global equities. And the other point that we like to make is that when people look at the market and they say, why are the shares going up? The point we kind of make is that don't assume that while the share market is a list of high quality businesses, don't expect that those businesses are anything like, you know, your local cafe, your local gym, pubs, or anything like that. We actually have a look at kind of the composition of I think this is the NASDAQ. You can kind of see that the Microsoft, Apple, Amazon, Alphabet, and Facebook make up half of that index. And these are incredibly strong businesses. They have incredibly strong balance sheets. Apple, for example, has around $250 billion sitting on their balance sheet. And they're in very strong competitive positions that we don't think COVID-19 will certainly have a short-term impact, but these businesses will still be strong over the long term. And so we think you certainly need to focus in, not in the short term, but about buying and owning businesses at attractive valuations that are going to prosper, not over the next kind of couple of months, but certainly over your investment time frame. So over the next kind of years and decades. Those are the slides that I just wanted to cover. So I'm going to pass over to Lee Cronin, and Lee's just going to talk through what he's seeing in the Australian equities area of the market.
Great, thanks, Greg. Look, the next couple of slides sort of just highlight what's going on in terms of earnings estimates within the Australian market. And as Greg sort of touched on, the top-down forecasts, if you like, so the forecasts of the strategists, so this is initially in the US context, the strategists are looking for this calendar year earnings to be about a third lower than last year. And that, to put some context around that, the earnings fall in the GFC was more like 45%. Bottom-up analysts, so the individual analysts that are forecasting company by company, and when you aggregate that together, it's a lesser fall. So the market analysts in the US are looking for about 20% earnings decline this year, and then about a 29% increase next year. So what that means, and this sort of dovetails in with one of the earlier charts that Greg put up, is that calendar 2021 earnings are expected to be about 1% above what they were for calendar 2019. So again, we're talking about a reasonably rapid recovery. In an Australian context, those sort of similar numbers are for a 20% decline this year, but a more modest improvement in calendar 21 of about 13%. Now, we're not saying those analyst forecasts are exactly right or wrong, but what the net result of that is that in Australia, we're expecting calendar 2021 earnings in aggregate to be still about 10% below what they were for calendar 2019. Now, that's a bit more cautious than what the RBA is expecting. The RBA is effectively looking for GDP levels similar for calendar 21 as to what they were in calendar 2019. So I think that's important in terms of context. And also, if you recall the chart that Greg put up before, what that effectively means is that we're looking for earnings to be recovered over a 1 to 2 year period. And again, in thinking about the fact that in an Australian context, we're still 20 to 25% lower than what we were in February of this year, before the market declined. The valuation effect of that sort of 20% decline and then a recovery over 1 or 2 years, that sort of dovetails into sort of more like a 10 to 15% decline in long-term valuations. So again, that sort of, I guess, gives you a bit of an insight as to why the market may well have recovered from those sort of sharper lows. The next slide just sort of shows you where we are. So in an Australian context, you know, we've bounced reasonably hard. 23rd of March looks like it was the lows. The market, as Greg mentioned, has a really high preparedness at the moment to look through the data. Again, it's a forward-looking beast, not a backward-looking beast. You know, GDP growth in Australia will likely be off 10% in this half. Total hours worked are off 20%. Unemployment will peak at more than 10% and probably more like 15% excluding JobKeeper. The market's going to keep being confronted with this sort of data and needing to ask itself, is this better or worse than what I thought it was going to be? And I think as long as the recovery from a health perspective, the fact that we don't see second waves, we do start to or do continue on the path towards reopening, and that data is not worse than what was being predicated, and that we don't need to, I guess, mentally shift from a V or a Nike-shaped recovery into something that's shaped in a more damaging way, then I think the market still has some ways to go. So in Australia, we haven't recovered quite as hard as what they have in the US. We're still 20 to 25% off our highs, whereas in the US, it's more like 10 to 15% off the highs. But bear in mind, as Greg alluded to, half of the US index is made up of, you know, the Facebooks and the Amazons and the Googles and the like, which are much different businesses to what we're exposed to here in Australia. On a sector basis, look, there's been a lot of volatility is the short answer. On the way down, we saw the energy sector, the financial sector, the REITs and consumer discretionary sectors all hit very hard, 25% down to, you know, 35, 40% declines on the way down for different reasons. You know, the financials, and we can chat about the banks. Happy to take as many questions as you like on the banks, but the banks make up nearly 20% of the Australian market. They represent about a third of the dividends that get paid in Australia. Dividends have been getting cut. Market's been worried about bad debts. Low interest rates are bad for bank profitability. So they've copped it in the neck a few times over. Real estate trust market's been concerned about, I guess, tenant viability and resetting of rents, as well as the balance sheets. And obviously oil prices have fallen quite significantly. The chart on the right sort of shows the extent of the declines on the way down in the red, and the extent of the bounces on the way up in the green. And you can see there that the financials haven't bounced as much as other sectors on the way up, whereas most of the other sectors, the harder they fell generally, the harder they've climbed on the way up. So that were probably the key sort of slides I wanted to chat to, and then we can pick up any more sort of sector or stock discussion as part of the Q&A. Is probably the best way to handle it.